Welcome back. You're watching India Tonight with Shivani and myself, Jude Sanith. Now, moving on to another important story we're tracking at this hour. India's family office ecosystem is rapidly evolving, with more than 300 family offices now operating in the country, up sharply from just 45 in 2018. Wealthy families are increasingly diversifying beyond traditional assets into private equity, venture capital, global equities, and real estate. My colleague Mitali joins us with what's driving this shift.
Right, so the Indian family offices are actually entering a new phase of growth with their assets, investments, strategies, as well as the wealth creation, all quietly expanding on a rapid basis. According to this report by EY, the Indian family office assets at around 70,000 crore rupees, which stood in 2024, they are expected to rise 1.5 times over the coming next 3 years. The opportunity is also being driven by the rapid expansion that we are seeing in the number of ultra-HNIs in India, and India currently has more than 19,000 UHNIs, a number that is expected to cross 25,000 by the year 2031. Also, at the same time, an estimated $1.3 to $1.5 trillion of wealth could be transferred over the next decade itself. That is putting actually a greater focus on governance, succession planning, as well as the professional wealth management. Investment strategies are quite evolving too. Alternatives could account for roughly 40 to 45% of the family office portfolio, spanning across private equity, the venture capitals, private credit, AIFs, REITs, as well as the InvITs. And family offices are increasingly looking at long-term growth themes including AI, climate technology, renewable energies, electronic manufacturing systems, cloud services, as well as the data centers. Technology is also changing how these investment companies, these family offices operate, with greater adoption of AI, analytics, integrated reporting, as well as the digital governance. So the bigger picture as of now is that the Indian family offices, they are moving beyond the traditional wealth management and preservation system, becoming more sophisticated, technology driven, and also focusing more on giving more important role in the country's next economic phase of growth.
To make sense of this report, we are now joined in by Surbhi Marwah. She is tax partner and leader, Family Office Advisory Services, EY India. And we also have Ashwin Patni. He is head Wealth Management Solution at Julius, Baer, India. Thank you so much for joining us today on ET Now. Let's go over to you, Mr. Patni. Now, Indian family offices seem to be shifting, as per this report, from passive wealth guardians to active, private market investors. What do you think is driving this transformation, Mr. Patni?
I think first and foremost, there is a rapid expansion of the discretionary wealth that is available to these family offices. What we have seen in the last 3-4 years is a massive spike in monetization opportunities, whether it is through the IPO route, the OFS route, or through private equity related exits. What they have also seen is because they are able to do this monetization so well for themselves, they also think are more comfortable now deploying money into such opportunities where they can also take advantage of the opportunities for themselves. So I would say two broad themes. One is just the sheer amount of capital or the monetization that we are seeing. And the second part is the maturity of the private equity ecosystem or the private asset ecosystem, where because of the quality of players, the sheer size of the opportunities, family offices are now very, very comfortable in terms of deploying more meaningful capital into these ideas.
Right, absolutely. And let me come to Surbhi next. But Surbhi, before I ask you my question, let me take a look at some of these numbers that actually make this discussion all the more contextual. Now, the number of family offices has risen from 45 in 2018 to 300 in 2024. And the report also shows that 57% of these family offices actually allocate less than 10% to private equity and venture capital, while around 25% allocate more than 20%. Is it a fact that Indian family offices are perhaps becoming more willing to take risks and invest directly in the next generation of businesses? Are they becoming more forward-looking now than perhaps ever before, Surbhi?
Jude, the numbers really speak for themselves. And what Ashwin also said was that they're becoming from wealth preservers to capital allocators. And given that this whole system is becoming more institutionalized, there is this professionalism that is also coming in. And yes, with the next gen coming in, next gen that is very well educated, next gen that is aware of the global opportunities, next gen that wants to also invest in areas and sectors which are part of India's high growth story, you will see that the risk taking ability as also, taking on more professionally led advice is increasing. And that's the combination of all of that is leading to the shift of allocations into alternatives, into not only, starting with the traditional listed equities, they're going into REITs, InvITs, private credit. They want to be LPs, they want to do co-investments. And it is a combination of much more wealth, but also the fact that you have another generation which is saying, I know this, but I'm also getting professional advice. And therefore, with that, my ability and my confidence to take risk becomes a little bit higher.
Right. Let's go over to you, Ashwin, Patni again. Now, how are you balancing, let's say, how are these offices balancing, the founding generation's preference for capital preservation with the next generation's push, for high-risk alternative investments? Help us understand that, since you deal with them on a regular basis.
Absolutely, and that's really the crux of the report, which is that the environment is getting more and more complex, and what it is forcing the family offices to do is to embrace much more institutionalization and systematization of their investment processes. So maybe 10 years ago or 15 years ago, you could get by with a more simplistic investment approach, which could be more product-led or largely led by the opportunities on the listed equity side. But given the sheer plethora of opportunities that are there right now, it is, and as Surbhi said, it's also about the interest of some of the newer generation that is coming in. It's actually putting a right positive pressure on the families to actually come together and pool together in terms of their thoughts and in terms of creating these systematic frameworks which allow them to participate in these opportunities without losing sight of the long-term goals of the family or long-term objectives of what the family was trying to achieve.
Right. Surbhi, the city where I come from, Chennai, almost every funding round for a new startup inadvertently has, a family office as one of the investors especially in the early stages of funding. So I sometimes wonder, Surbhi, are family offices now evolving, on a place where they can actually see themselves on par with institutional investors, with the scale and sophistication to invest alongside and sometimes even compete with private equity and venture capital funds? Do you actually see that happening given this progress that these family offices have seen in the recent past?
So, Jude, it's a matter of the amount of wealth that is being created. You pointed out the numbers. The numbers are absolutely, the numbers speak for themselves, like I said. When they have that kind of wealth with the number of IPOs, the number of OFS, the PE exits, the other exits happening, when the amount of wealth in their hands is so large, then yes, the area or the level playing field becomes a lot larger as well. And what family offices are also doing is that because they are, they're also focusing on governance and succession and a lot of strong MIS, their ability to therefore contribute bigger checks becomes a little bit better because they have a whole machinery behind them which advises them and they can play in the big league as well. So yes, when the sizes of the checks also increase, the areas available to the family offices or to an individual also increase. So it's actually very clearly a matter of the numbers, a matter of the institutionalization, a matter of how they do their MIS, the technology, and of course the new gen coming in with new ideas, much more ability to take on risk and just a lot more visibility and information. So with greater power comes greater responsibility and vice versa. That's really what it is.
Rightly pointed out, and this is Spider-Man dialogue, and we live, in the Spider-Man weeks of late. It has been such a blockbuster success. But Surbhi, on that note, let's speak about the legal aspect of it a little bit. As some of these family offices, expand into global private markets, how effectively are they, are they looking at the legal aspect of it? Because, there are many, like cross-border capital capital flow rules that are in place. The legal structure is a little complex, including for, the foreign direct investment and also the FEMA implications for that matter.
So, Shwani, it's when a family office wants to go global, and we've seen a lot of family offices wanting to diversify because of just that's the investment philosophy that a lot follow. There are a couple of global hubs that they look at, which are very popular: Singapore, Dubai. Then you have the Gift City, you have Lisbon, you have Zurich, you have London, etc., and not in specific orders. But in each of these, they decide based on their criterion, their personal situation, the tax treaties that these countries have with other places, how easy it is for them to diversify from that particular country. But in every possible jurisdiction they select, the underlying legal, FEMA, tax consequences are something that each family office does come and evaluate, and our legal structure is very tight. So anything that is done within the four walls of the law, and the structures are complex. However, there are structures that can be done, structures that are kosher, structures that tick off all the boxes. But that is also the reason why there is so much focus on family offices, because within the four walls of these structures, and when they tick off all the boxes, they are able to then move ahead and say, we are also looking at family offices and we are also looking at global hubs. So very much the governance, the legal aspect, the tax aspect has to be ticked off. And very often the choice of the global hubs depends on the tax breaks and how easy or difficult it is from an Indian perspective and also from that country's perspective. So it's a combination. That's where advisors come in. We look at everyone's situation. We look at their family situations. Sometimes it's just a reason because an individual is living over there. But within all of this, and after ticking off all this, does that decision happen, and then how the capital is allocated. So it's not an easy one. There are lots of decisions involved, and therefore you will see that a lot of next generation, lot of next gen say, if there's been a PE exit or there's been an IPO and I have a bunch of cash, I will run the family office, and it's not an easy thing to do. It's a job. It's a huge job in itself. It's a business in itself because of these reasons.
Absolutely. Well, it is a business in itself, no doubt. But one thing's for sure, the era of family offices is well and truly upon us, and for all you know, could well be here to stay. But on that note, Surbhi, Ashwin, thank you so much for joining us on India Tonight and breaking down some of those insights, as family offices, it seems, are all set to head into the fast lane. But on that note, we're slipping into a short break. But don't go anywhere, because India Tonight will be back on the other side. Keep staying tuned to India Now.